So you want to learn a little bit more about trend lines. Fantastic. Trend lines are the third of the primary indicators. So we've learned a little bit about support and resistance, but now we're going to learn about the third being trend lines. Now, trend lines are basically the same as support and resistance, except they're sloping. So there's a couple of different trend lines that you can draw on your charts. The first one is an uptrend, and obviously the second one is a downtrend. In this example on the pound versus the Australian dollar, we can see that the market's moving upwards. But when we draw in a trend line, that will give us a bit more clarity as to where that trend line is. So if we go down to our drawing tools and we click on trend, all we need to do is click on where we think the low is and then find an area that we think the trend ends. So if we click up here, we can start to see that each time the market reaches this line, it goes back up in value. Again, it comes to this area here and starts to go back up again. So there's a number of different ways that we can trade off the back of these trend lines. The first one is that we think that history will repeat itself. That once it starts to bounce down towards this trend line, the market will go up and we can do a buy and make some money off the back of that. The second way that we can trade off the back of trend lines is if we have what we call a breakout. And as you can see here, you can see that the market, once it came down to this trend line again, it's actually broken through. And here, this is actually what we call a technical breakout. So what we would do here is we'd simply put on a short trade with a stop loss just above. Now, the reason we put on a stop loss is just in case it's a false breakout. It breaks down a little bit, goes back up and follows the trend. So we want to make sure that we have our risk management levels on. So really important to do that. The second way is to use trailing stop losses. And with a trailing stop loss, if the breakout occurs, it will trail down with that price movement. Okay, so if the price starts to bounce back up, which it quite often does, and retest that level, well, we can actually then get out using a trailing stop loss. That's what we call an uptrend, but you can do the exact same thing on the downside. So if we have a look at a chart, here we have of crude oil. Now, crude oil, if you're looking at this chart, you can see a couple of different trends coming into the marketplace. But what we can see from this period up here down to here is a general downtrend in the marketplace. So if I click on the trend line here, click on the high, and then move it down to a significant lower high, you can start to see that each time it comes up to this line here, the market falls. Reaches this line, the market falls. Again, the same principles apply. If the market starts to reach that level, we think, okay, we think the fundamentals are still down. We will do a down trade or a sell trade and try and profit from that bounce. The second option, again, is that technical breakout. If it breaks above the trend line, what we want to do is we want to take advantage of that change in fundamentals. Obviously, something's happened in the marketplace, which is starting to push the price away from that downtrend. And so we want to get on the back of that particular price movement. So again, buy opportunity just above that trend line, but make sure that you put those risk management levels in and put a stop loss just below. So there's two ways that you can trade off the back of trend lines. Go ahead and have a try for yourself, and I'm sure you'll start to find some trading opportunities as well.